Hello everyone and welcome back to another video in my channel Order Flow with Ethan. So I'm Ethan, I'm 20-year-old and I've been trading order flow for roughly 4 years, which had made me gain great knowledge on how the market works and also made me make great profit in this great market. So in this channel I'll be breaking down step by step what's order flow and how does it work so I can make you master the art of order flow. So this is the third video on my channel, how to read the order flow charts. So you'll be understanding how order flow actually works. So welcome to my channel. Please make sure to subscribe, like and comment. So in this video we explain why order flow trading gives you an edge that traditional charting and indicators simply cannot. So I'm also going to show you how exactly you can read charts and learn how to use these informations in your daily trading. So because you're trading on futures market here, when comparing prices on an order flow chart, you have to do it diagonally from the left to the up on the right, not horizontally. So futures market no longer trade in a fixing in that they when it gets to a price like 1.1244, all the people want to buy it and sell it at that price can. So the way the markets work is traders put in bids and offers and people buy it and sell accordingly. So here, this 1244, so we have the bid at 18 and we have the offer at 86, and then it keeps on going like that. The people on the high want to sell, people on the low want to buy. So this is how we basically compare prices on order flow chart. So in the candle, we should always have a 0 here and a 0 here. Why? Because if we say 1240, well that starts on another candle, not on this one, because here it starts at 1241. So you can see 94.9. Here it goes from 94.42. It goes from 29 to 38, and then we keep on going till 1247, where we can see 30 against 37. What do we call this? We call it unfinished business. I'm gonna explain this later for you. I don't want to make you confused now. So it always should be a 0 here and a 0 here. Why do I have 17 here, and what does it mean? I'll explain it later. So because you have a 0 here, this candlestick starts at 1241 and ends at 1247. After 1247, which is 1248, that's another candle and starts with another number again. It goes up and up and up with 0 here, 0 on the bottom right, and 0 on the top left. So next we'll be moving how the market works. There's always a bid and an offer in the market. Buyers place bids and sellers place their offers. So when traders no longer want to wait, they execute at the market. So buying at the offer or selling at the bid. This interaction is what drives every transaction in the market. This is actually kinda deep, but I will try to make a video explaining exactly what's the bid, what's an offer, what's selling, and what's buying in the offer and selling the bid. So we have two types of trades in the market, which is a passive trade or a market trade. So market trade, when you enter at, let's say for example, you want to buy at 1244 and you just go and sell at 1244 or buy at 1244. But if you want to buy right now and get executed in the market, I will be entering here at 1245. So this is basically how the market works. If I want to execute now, I may be getting in the trade in a position slightly higher than the one I wanted at the beginning. Or if I buy the bid, well, I will just wait for the bid here. For example, I will make an order at 67. When the market reaches 1243, then I'm going to be entering the market, and that's how it goes in this market. And this interaction is what drives every transaction in the market, and that's how we can see manipulations done by big institutionals. So I'll be explaining everything because these are very important data. This would be the subject of the next video, okay guys? So what does order flow show us? First of all, the order flow charts go beyond just price and total volume. They show where the volume is traded, specifically whether it occurs on the bid, which is selling, or the offer, which is the buying. And this would be the next video's subject. What's a bid and what's an offer? Because you need to understand the difference between aggressive sellers, aggressive buyers, passive sellers, passive buyers, a bid and an offer. So this allows traders to directly compare buyer and seller activity in real time. And when you can compare the buyer and seller activity, that's when you have insider information about the market. That's not really insider, but you're ahead of people using normal traditional charts. And that's why order flow seems to be complicated at the beginning, but later it becomes easier. So let's understand the footprint color. This bid versus offer activity is what gives footprint charts their meaning. Green equals aggressive buying, more trades at the offer. So green and blue in general means aggressive buying. So all these blue colors mean we have aggressive buying. But when we see red color, it should be aggressive selling. There's more trades at the bid. When you see neutral and black, it means you have balanced activity by visualizing this information. So let me tell you exactly what does it mean. It's actually called an imbalance, but what does an imbalance mean? We're going to explain that in the next videos, okay? So you can see here we have 6 versus 0. So as we said, we go up and down. So here we have a normal candle. You see 0 in the bottom and 0 at the top. Same thing here and same thing in this one. That's a healthy candle. But here we have unfinished business. What does it mean? As I said, I'll be explaining on the next video. So here we have 35 against 0. So 35 is more than 35 times higher than 0. And that's why we can see that that's an aggressive buying. That's an imbalance. The people buying the bid are higher than people selling the offer. So we have 25 against 1. That's 10 people selling against 1 person buying. And you can see the difference. Then you can decide that's a good trade. You can see 39 against 1. That means the buyers are weaker. And this gives you a great insight about how the market works in general. That's how you're ahead of people using normal traditional charts. Also here, 2 people are selling, 31 are buying. And that gives you great information about the market, okay? So why price matters and what moves it? Price is the most important element in trading because it determines profit and loss and drives all market decisions. Traders aim to buy low and sell high, but price alone doesn't tell you the full story. Price moves when there is an imbalance between buyers and sellers. So what likely moves this candle to go red? It's because you have 39 against 1 here, 10 against 1. But here it's a bit unbalanced. Although it's slightly more than 3 times difference, it's still an imbalance also here. 31 against 13. See what? Oh yeah. So these are here. It's more balanced here. But at the top, you can see 10 against 1, 51 against 13, 31 against 13 again, and 39 against 1. And here, it's another story. 4 against 5, 35 against 0. And it keeps on going like that. So the price alone doesn't tell the full story. As you can see here, it's the imbalances between the buyers and sellers. So more buyers push it up and more sellers push it down. And that's basic economics 101. If you take trading like this, you will be succeeding likely, okay? So not every move is strong, but how price levels leaves an area determines whether the move will continue or fail. The context and real market behavior. A large move on the chart, like a strong down candle, may appear powerful, but can quickly reverse if there is a hidden buying or lack of follow-through. Without volume or order flow, it's difficult to truly understand who's in control. Markets don't move only because of more buyers or sellers. Sometimes prices rise simply because sellers are absent or fall because buyers are weak. Institutional participants often play a key role, absorbing orders and influencing the true direction of the market. So let me break it down, okay? It seems too complicated, it seems gibberish for you, but let me explain it to you. That's not math, that's easy and basic economics 101. So without volume or order flow, there's nothing that's going to move the market because we don't understand who's in control and the market itself doesn't understand. If people are not buying and not selling, then the volume that's not there, that's not going to actually move the market. It may appear powerful, but can quickly reverse if there is a hidden buy-in or a lack of follow-through. So if there is a lack of follow-through, the market keeps going up because people are buying. Once they stop buying, the market would go down because sellers will realize there's no more buyers. So you could just understand that it's like a war between 2 people, which are the buyers and the sellers. The buyers will keep buying till they reach a level, oh, it's too expensive. They start selling. Then it keeps on going like that. Or they can just keep buying and then it would be like, oh, this price is too expensive for us to buy. Then there's not enough support to actually face the sellers that think that the market is too high and they should start selling. Then the market goes down. And that's where your role should come. You should know when the buyers think of buying and when they think they should stop, when the sellers think they should get in, and when they think the price is too low to keep selling. So that's what order flow shows you in general. So thank you for your time and see you in the next video. Please, if you have any questions, do let me know in the comment section. And I hope this video was helpful actually for you guys. I'm really appreciating all the support I receive, so please make sure to subscribe, like this video and comment, and please make sure to let me know if you want me to cover anything regarding order flow. So thank you guys, thank you, and I'll see you in the next video where I'm going to talk about the bid and the offer as I said before. So thank you and have a good day.